happier days are here again. That's my thesis for many companies, certainly not the financials, even after the dramatic decline we had yesterday. It's still true, even with all the turmoil in the banks, brokers, insurers, because it has nothing to do with them. The price of oil is falling through the floor. Gasoline's right behind it. I think it's going to go through $3 a gallon. And every other commodity, including food, is getting slightly cheaper too. That's got to be good for someone, right? Someone with no connection to the problems at Lehman or AIG. Back on September 10th, I recommended Darden, the parent company of the Olive Garden and Red Lobster, not to mention Longhorn Steakhouse, Capital Grille, Bahama Breeze, and Seasons 52, as a happier days are here again play. I said more people would be going out to eat. I thought Darden's earnings would be in line to better than expected going forward, not necessarily this quarter, because we already knew what this quarter was going to be, and I expected input costs to go down. So therefore, I thought Darden would benefit from the fact that so many other casual dining chains are going out of business, think Bennigan's, or closing restaurants, while Darden is still opening new ones. I said it could survive and thrive because they've got great scale. And not unlike Panera's up nicely today, McDonald's up nicely today, I think that Darden is just a matter of time before it starts ramping. Today, the company just reported 58 cents a share. They had told us at the end of August it would be between 57 and 59. Hey, they haven't given up on themselves. They bought 2.1 million shares this quarter. I think they've got a great story to tell. And I think they're a great place to eat. That's why I want to bring on Darden's chairman and CEO and a friend of the show, Clarence Otis. Welcome back to Mad Money.
Thank you. Good to be back.
All right, Clarence, I got to jump right to what I think fits my thesis. You can shoot me down, but you talk about how while there has been some recent improvement in energy prices, I have a feeling that this quarter, and you can give us some granularity, got better as it went along. Could I be right?
Well, we're usually not in the habit, Jim, of talking about the current quarter.
But you're not in the habit of coming out on Mad Money after the quarter, so I figure I'll break the mold.
What I would tell you is we gave some guidance and an outlook for the rest of the fiscal year. And we are pretty conservative in that outlook in the sense that we are not expecting things to get better in the near term. We acknowledge that there are some things that are better today than there were 3 months ago, and that's good. But there also continues to be some real turmoil and I think some real pressure, not just on people's spending, but on consumer psychology as a result of some of the things we're seeing in the financial markets and elsewhere.
Now, one of the things that I felt like highlighting your company for is because over the long term, forget this near term, you have consistently come out of difficult or troubled times stronger. Will this time be any different for Darden?
That is our goal, Jim, is really to emerge from this downturn a stronger company, better positioned competitively. We think the work that we've been doing sets us up for that. And so with the acquisition of Longhorn and Capital Grille, we think our portfolio of brands is more proven. It's got a better long-term sales and earnings growth profile than we had before. As you've mentioned, we've got tremendous scale, lots of advantages that come with that in terms of buying power and some other expertises. We have built on that scale, and so more advantage. We're working hard to change how we work at the margin so we can take better advantage of scale. And we think all of that will help us as we emerge from this slowdown and get back to a more normalized environment.
Now, I know I should have I buried the lead, but I wanted to get to that one line which talked about things getting brighter. But this report is exactly consistent with that reduced guidance that you gave. Nothing worse than that, right?
That's right. That's right. I mean, we talked 3 weeks ago when we pre-announced our first quarter about what we thought it would come in at, and it did come in there. We talked about what we thought for the balance of the year, and we're still there. We're looking, we think, at earnings per share growth that's somewhere between flat and up 5% for our year that ends at the end of May 2009.
I found a couple of things I wanted to highlight. It looks like we're back to the days you made some acquisitions, Longhorn and Steakhouse and Capital Grille. We're back to where you take over a company and then you start jumping the numbers. Talk about the improvement that you have year over year in Longhorn, and particularly in my favorite fabulous restaurant in Midtown New York, Capital Grille.
Well, there are two dimensions to it, Jim. One is that we've got a restaurant support platform that we think is the best in full-service restaurant business. And so from a purchasing power perspective, from a lot of the IT and finance support that we provide, and we see the benefit of that in the acquisition cost synergies. We talked about run rate cost synergies when we announced the deal of about $40 million a year. We think that's more like $50+ million. I think that speaks to the power of our platform. We captured about $10 million of that in our last fiscal year. We'll add another $30 million on top of that this fiscal year. And so that is one side of the equation. What's equally exciting to us, we think, is the top line. And so in the case of Longhorn, one of the things that we bring to the mass brands is brand management capability, advertising, brand positioning. We think we can marry that with the strong restaurant operations that Longhorn has and that they built their company on, and ultimately over the long term drive significantly higher unit volumes in terms of traffic and sales.
One last question. In areas like I've got my Olive Garden, I mean, I don't want to be too anecdotal, but my Olive Garden that I love is literally across the road in Jersey, in Route 22, across the road from a Bennigan's that, frankly, I didn't really care for. But when you see the Bennigan's go under, are you seeing a little pickup in traffic in a nearby store of yours?
We do see the effect of restaurant closing. So we do get a pickup because an Olive Garden is just a trusted brand. Where you want to be in this environment where people are cutting back on the number of visits is one of those top 2 or 3 favorites. And that way you can get your share of the business that's still there. Olive Garden has done that. You see that in the same restaurant sales growth numbers that they continue to report, 56 consecutive quarters of growth, even in this kind of environment. And so clearly rationalization of the market helps us. We would expect that to continue given the consumer pressures and the cost pressures that we're seeing in the current environment.
Excellent. Mr. Clarence Otis, thank you so much for coming on the show.
Thank you.
Guys, look, this is the kind of long-term story I am urging you to get involved in as gasoline comes down, the expectations are lower, they delivered a great number, they deliver great food, and I got to tell you, it's not all bad out there. I want to thank Darden's Chairman and CEO, Clarence Otis, and I say we got to keep looking for bull markets wherever we can find them. Stay with Cramer.